Everyone, welcome back to the NQ Addict Scalping course. My name is Chris Drysdale and I'm an NQ Addict. Welcome to Module 2. This is going to be a basic strategy overview, and we're going to kind of dive into the overarching concepts that dictate how this strategy works. So the top kind of concept I want to dive into is that of balance versus imbalance. Okay, this is a market concept where price is either in balance. This is also known as a value area or ranging market conditions versus imbalance. And this is where we would find trending or a market that's in price discovery and moving out of a balance area and moving to a new balance area. So when price is in balance, what we have is generally an agreement in price, and price tends to range in a particular area for extended periods of time. You'll hear traders calling this the chop or going sideways, and how this stuff is untradeable and blah, blah, blah. And the reason it's untradeable because they are price discovery traders. Okay, they need the market to move strongly in one direction for them to make money based on their strategy. We are balance traders, okay? So we love those conditions. Give me the chop. Give me the sideways action. Give me the predictable amount of movement I'm going to get, okay? So when price is imbalance, there's significantly more buyers or sellers that are putting pressure on price and moving it directionally to what will ultimately become a new balance area. And this happens generally with some speed. Okay, you might have heard that the market spends 80% of the time ranging and 20% of the time trending, right? So that's technically what we have here. What you also need to know is this behavior is fractal, the nature of balance versus imbalance. And that means that this behavior repeats across different time frames. It happens on as low as the 15-second, to the 1 minute, to the 5 minute, to the hour, to the daily, to the weekly. Okay, this pattern is visible on short-term charts and can be seen again on longer-term charts, demonstrating a similar pattern characteristic. Okay, so what you need to know about this is you need to essentially be aware of what's happening on different time frames, on larger time frames, but focus trading on your current time frame, because these same patterns, we might be in balance on the 5 minute, but on the daily, we might be in imbalance. Okay, so it's important to keep in mind that the different things are happening on different time frames. So for this strategy, we only trade when the market is in balance. Okay, and this is generally on a lower time frame. Okay, for me, the 5 minute. Therefore, when the market is clearly in balance, so it's clearly moving on a short time frame in one direction quickly, away from prices that have been trading at for quite some time, we sit on the sidelines. And we're going to wait for a new balance area to develop. So it slows down and it starts to develop a range, a tradable range. Okay? This keeps us out of hot water with this strategy. And we have rules of balance trading. Okay, there's general concepts that give us ideas to trade based on balance and imbalance. So for example, if we break out and accept pricing above a value area high, so above a balance area, we break out, we accept pricing, we can expect continued price discovery to the upside. If we reject, we can expect a return to value. If we accept pricing to the upside and price discovery commences, we sit on the sidelines and we wait for a new balance area to establish. To the same vein, if we break out and accept pricing below value area, then we can expect continued price discovery to the downside. If that happens, we will wait for a new balance area to establish. Okay, so you can imagine these value area highs, these value area lows are significant areas we need to watch. What happens at them? And those give us our trade ideas based on balance trading. Okay, they're great reversal points. A couple of additional rules are if we hold value area low, so we're in balance, and we hold the lower area, we can expect to return to and accept back into value area low. We can expect to then return to the point of control. That's the highest volume level traded in a balance area. And I'm going to give you demonstrations of what this looks like. Okay? We just need to get through the rules and these concepts, and you're probably going to have to print this out and go back to them as you review. All right, so we fade the value area extremes. If we can't escape value, we're in balance, we test, we try to escape value, and we cannot, we expect a return to value, and the next stop is the point of control, and that's going to be the highest volume traded price level in the balance area. The opposite of that is if we hold value area high or return to and accept back into value area high, we can expect to return to the point of control. So this is just the same concept reversed. We try to break out a value to the upside and we cannot, we will return to the highest price level traded, okay, the point of control. So based on these rules, it's going to really create an overarching framework for our trade ideas while we're in balance. And so the next obvious question is going to be, how do we determine whether the market is in balance or imbalanced? Okay, so we're going to really dive into some different tools and indicators, and we're going to explore more the concept of balance versus imbalance. What does it look like? How do I identify it? And then once we do, what are the trade setups that we can utilize to take advantage of that market condition? Okay, so the first one that we're going to explore is the volume profile, and that will be in Module 3. So we'll see you there.